Nicolas Link. I'm sure a lot of you call me a lot worse things than that right now, but here we go. So I'm going to do a series of videos, a lot of clips on all the different companies. Over the next few days, we'll be releasing them, or next few days / week. But I thought I would start with my usual, as I normally do when I do these videos, a little bit of an overview from a macroeconomics point of view. And this is really macroeconomics, for dummies 101, from a non-economist point of view. This is really from my personal view, not from the company's. It's not investing advice, it's not trading advice, it's not advice in general. This is my personal view, sitting behind a desk, running a number of companies, both private and OTC, and what I see on a day-to-day in real life, not necessarily, punted propaganda from the media. And so I'll just touch on some of those. I think in general, I got a much better outlook than I did the last time I did a podcast for you guys. Previously my outlook was pretty grim. I think I even said we're going into a hell of a storm, with a recession potentially looming, blah, blah, blah. I'm a little bit more bullish now. I've kind of more got a neutral slanting onto positive outlook, which is, I guess, a good thing. And I'll tell you what brings me to say that. One is, I think, obviously, inflation data is starting to, show some positive signs. The banks are obviously way more resilient than they were previously. So despite we've got this, massive 600 billion plus bond loss that are sitting on the banks' balance sheets, I think the banks are much more resilient than they were in 2007, 8, 9. So hopefully we'll be able to stomach that and hold it for a longer period and, see how it plays out. So God, I hope I'm not wrong and we wake up tomorrow to a crisis, but I'm a little bit more confident in things in general. I think there's a big shift, or a big power shift between East and West, which I've mentioned previously. I don't see that going away anytime soon, but that brings a hell of a lot of opportunities, certainly for all our businesses where we operate, exactly in that gray area between the two. I'm personally based out of Dubai. Those of you that don't know, most of the company's HQs, back office, the accounting teams, finance teams, most of the teams sit in our head office in Dubai, while our operations are in Europe, Eastern Europe, Middle East, Africa, and and US. So we kind of sit in a real comfortable space that we can maximize on the opportunities on all angles. But we certainly, because of our impartial sitting in the middle view, we very much feel the tug of war of power shift from East to West. And obviously that has a natural knock-on effect, both positive in terms of opportunities for us, but also, in terms of a risk point of view on the US dollar and the bonds, etc. But, I think in general, I'm hoping that, we're in a little bit of a period of stabilization. So, I'm a little bit more confident in that space than I was before. I think with the inflation data showing a little bit better, Christmas is probably going to be a little bit cheaper than it was last year for people, only fractionally, but it's moving in the right direction. Interest rates have obviously been stabilized. I probably don't, again, not an economist, but probably not going to go up, again, maybe a stable period for a while. And then who knows, maybe we'll be lucky to start seeing some decrease, at some point in 24. But again, it doesn't seem like it's getting worse, which is obviously way better than where we were last time. So I think obviously that's, probably going to show that the markets have either hopefully close to bottomed or already the bottom has been priced. Which again will give us, a little bit of a bullish outlook into 24, that hopefully things in the curve starts to go the other way. Obviously, again, this is not investing advice, right? This is just the way I see it. I'm hoping that the worst is behind us, even if we maintain this position for a while. And again, I know, sort of we're going to an election year, so we've got this propaganda going on continually. And again, the East and West thing that I keep mentioning, the markets in general, bar S&P and kind of the top tier companies, the rest of the market is still a dog show. And it has to start to show some signs of recovery. But in general, again, that brings us opportunities. When I talk about each individual company over the next few days, next week or so, we've been consolidating, we've been getting ourselves into an organized position to maximize. If you go back to the podcast I did, I think it was earlier part of this year, where I said that was kind of going to be our strategy. While there's a ton of deals on the table, it wasn't the right time to take those. A lot of those deals got cheaper, and they've bottomed, as I say, hopefully bottomed or close to bottomed, so now is the upside. And, I'd like to think a lot of you people are going to get very, very wealthy over the next 3 years, out of being able to get into stocks. I'm not saying our stocks, I'm saying stocks in general, at a pretty low price. I know a lot of you are limping and been severely hurt, on this downward spiral, again, not just on ours, but on the market in general. But hopefully now's the time, for steady hands and, confident, trusting investing going forward. Again, not advice, right? I think also potentially what's happened, which is helpful to us, and I know you guys may not see this in the short term, but there's a lot less good stocks on the offer. I think specifically on the OTC side, companies have really struggled to raise money, us included, which I'll talk to about when I talk about the separate companies, ILUS and CGRA and QIND, DRCR, etc. They're all at different stages, but in general, as a macro, companies have struggled to raise money, which means a lot of them have not been able to do deals, haven't been able to actually consolidate or actually structure their business for the next phase, and potentially going to basically either come off the market, get CE'd, get delisted, can't afford to pay their auditors, can't afford to get stuff done. It's a struggle. It's a real dogfight out there to raise capital. And in the end, although liquidity across all the stocks has shrunk dramatically, what I think is going to end up happening is we're going to have a lot less liquidity, but for way fewer stocks, which ultimately will mean that the fewer stocks are getting a much better liquidity point than they probably had previously. And I'm as we've said, JP has said, I've said, we're very confident in our business, we're confident in our strategy, we're confident in our management team, we're confident in our abilities. So we're very confident that will start to pull through, as 2024 goes, into the year and on and through 24. That hopefully people will see our steady hand, we'll see our steady strategy starting to materialize, and that will bring an influx of investors moving from, let's say, weaker stocks into stronger stocks that have a much steadier outlook or much positive outlook, with real revenue, real balance sheets, etc. So while I say that, I think there's been a massive change in trading habits. I think, sorry to say this bluntly, but those that know me, I call a spade a spade. The dumb money has either already been wiped out, or is going rapidly. The days of just everybody just following a tweet saying, buy this company, it's going to go up. The old pump and dumps, they're not there as prevalent as they used to be. I think that dumb money, that just a sheep following the next sheep to the slaughter, is gone or going. And I think crypto also helped to wipe that out. A lot of the guys that made fortunes in buying shit coins is gone as well. So now we're left with much better quality traders, much more patient traders. I may not feel like that, and certainly doesn't in my inbox every morning. But in reality, the traders that are still in the game now are, let's say, much more sophisticated, much more experienced, have a much more wiser outlook, much patient, much more steady hands, and they realize that they've got to, see things through. They've got to actually know what they're investing in. They've actually got to do their due diligence. They've got to get to know their management team, and they've got to buy in and believe in the team and the company and the strategy and all of that. So again, that'll come down to better companies that have that information available for them to actually make that educated decision. Where historically, I think nobody really cared. It was a 4-letter ticker. 3 influencers said it was a great idea, and they rushed in, got a pump, made some money, jumped out, or got burned, bought another one and tried again, and they just kept doing it, repeat. Obviously, let's say the crapper stocks with less balance sheets, less cash flow generation, less management teams, those have just dwindled, and unfortunately, sadly, those people have been destroyed. So that's changed the behavior, which naturally changes a company's strategy, or should change a company's strategy, or PR, investor relations, awareness campaigns, because no longer are fluffy PRs relevant. Historically, 2020, 21, 22, a fluffy PR, any PR would just send a stock through the roof for a day or 2 or 3, and then everybody would sell off the volume or sell off the back of it. Now, basically, any PR, even a good PR, a PR announcing an acquisition, strong revenue, actually has very, very little impact. That market excitement is not there anymore. It's much more steadier. Don't get me wrong. I'm not talking general. I'm talking much more a generalistic view as opposed to specific examples. Because I know you'll say, oh yes, but this stock ran yesterday. This stock ran the day before. I'm talking a generalistic view. The proper companies now really need to focus on the quality of their materials, the quality of the PRs, the substance behind the PRs, and ultimately what it's going to lead to, and still not expect an uptake. When a PR goes out now, we don't expect an immediate 5, 10, 20% uptake like we would last year or the year before. We now know that information is going to disseminate through the market. If anything, at a worst case, what it's really doing is giving people confidence to stay. And I think that's probably what across the market what people are looking for is confidence to stay and maybe buy more. Where previously it was always looking for confidence to buy more, guaranteed. Where everybody was now, always looking at every stock. Should I go? Should I stay? Do I trust the stock? Do I trust the people? Do I trust the markets? Do I trust OTC? So, I think that strategy of awareness has changed and has to change and will continue to change. Maybe next year as, the market starts to get a bit more, hopefully a bit more liquidity onto certain stocks, that excitement may come back again. But from our point of view, it doesn't change our business. And I think this is what we've been saying from right early on from our ILUS journey. Trust the process. We've said it 1,000 times. It's on our boardroom wall in massive letters. I'm sure somebody will be able to share that image on the Twitter. Trust the process. And that process can't be measured in 1 day, 1 week, 1 month, or even 1 year. This is a process, an ongoing long-term process. And you've obviously often heard me refer back to guys like Berkshire Hathaway, Warren Buffett, one of my role models or icons. They've amassed, I don't know, whatever it is, 157 billion in cash reserves. That didn't happen overnight. That's come out of a progressive investment strategy, which is what we are trying to do. So I know we hear, and some of the companies regularly get beaten alive that we promised this, didn't deliver that. Everything in all our companies that we say or promise, every single company, and I'm talking generic, every single company we're involved with, anything we say either has been delivered, will be delivered, is in the process of being delivered, or is coming. There's very, very, very few that we said we were going to do something and it's in the bin because it just didn't work out. The route may have changed, the way we're getting there may have changed, the way we finance may have changed, but ultimately the direction of the business is still exactly the same. We are on track and it just takes time. Hence, I refer back to the steadier hands, the steadier hand investments. That's a real thing. This is the process of building a business, and through these times, where the markets and the macroeconomics are not in your favor, this is a time to consolidate, change in behaviors all round. It's a time to get leaner. It's a time to get smarter. It's a time to think about doing things differently, but doesn't mean reaching a different goal. And it's a time to basically cut out the dead wood. And as I said on my video earlier in the year, that is what we were planned to do, and that is what we have done. None of the deals, I don't think any of the deals that we were working on earlier in the year are gone or dead. They might have got cheaper. The deal structures that we've been talking about may have changed, but we haven't executed them for a number of reasons in a lot of the companies. One, because we felt we could get a better deal later on because everybody's been struggling to raise money, which is where we're reaching now into 2024. It also wasn't the right time. I mean, you guys wouldn't want us to execute a deal, refer back to the share prices. You wouldn't want us to execute a deal taking money in at a low share price that's actually not going to have much of an impact on the short, medium term, and some of those businesses that needed further cash to develop. So coming back to that consolidation period, we believe we've done well. We had a good strategy, we've executed it well, and we now feel we're in a really good standing for 2024. Of course, capital continues to be an issue and will continue to be an issue into the first half of 24, I would imagine. But we're pretty comfortable in our strategy and how we're doing it going forward. So that being said, I think on the change of behavior of traders, I believe that suits us well. Our information packs are good, our data room is good, the data we provide is good. We provided less fluffy PRs, and the PRs will start to get a little bit stronger. Yes, during this consolidation period, there hasn't been much to report or much exciting point, but that doesn't mean there hasn't been stuff going on behind the scenes. And as we go into 24, that'll become very, very prevalent. So again, staying on the macro, I think we've got some unknowns around AI in general. How that could affect all the businesses, whether it's trading behaviors, advice on trading, whether it's physical tech in some of the businesses that we're involved with, like DRCR, so we kind of got to watch that space. But it's an unknown. It doesn't mean it's good or bad. It's an unknown. Again, as I said, this is sort of my macro overview on how I see things. Things that I think about on a day by day basis, things that keep me awake at night, things that I've got to strategize ahead of the game. So I'm just showing that macro view, as I said with you. I think there's going to be 2024 is going to be an interesting outlook for EVs, which obviously some of our businesses are involved with, direct EVs, but also minerals and technology for EVs. I think the EV has not been as successful as people thought it would, for a number of reasons. One, I think it was heavily driven by political motivation rather than real facts. The cost of renewing a car, you buy a petrol or a diesel or gasoline car and you sell it in 5 years time or 10 years time, it has a real value. It depreciates a lot, but it still has a real value. EV cars, I think the second-hand value is still unquantifiable. The majority of the car cost is in the battery, so you really feel that depreciation more than you would have on an older car. So while it might be cheaper to run, so I think there's some economics around there that people are rethinking about. The charging station still remains an issue globally. The access to some of the metals and minerals and stuff around the manufacturing side. The real impact. The cost of producing. I think there was a lot of, let's say, smoke and mirrors around the political debate in the front end. Obviously, the cost of producing the additional power that it requires to charge these vehicles, and that's got to come from anywhere, right? So there's still a massive CO2 and a massive environmental impact around producing extra power to do that. So yes, it's probably advantageous. I'm not a specialist in that sector, but I think again there's some issues and there's some opportunities, and again I think we're in a pretty well position to maximize on both. So just sharing again thoughts that are in my head. So moving on, I think this is in summary, this is a great time to build great businesses. It's a great time for investors and shareholders to build a great portfolio of stocks that are probably at the lowest they might ever be in history. Who knows? And I guess it's not advice, but my thoughts are that it's probably not a good time to compare your position to where it was, let's say 18-24 months ago, because probably I don't imagine there are many of you that can say you are as better off as you were 24 months ago. But let's say hopefully looking forward 18-24 months, you may hopefully be in a better position than you were a year or two ago. You've just been through this curve. So it's really up to you guys to make steady decisions and follow the real news and follow the real research, and do your own due diligence. But in general, overall, I'm much more comfortable than I was at the beginning of the year, much more comfortable than I was even 4, 5, 6 months ago. I certainly see the light at the end of the tunnel now, and I feel like we can navigate our way through the storm. I'm not talking me in general or our companies, I'm talking macro. I feel like the world is going to hopefully get through this. Hopefully the wars both in Russia and Ukraine and Israel and Gaza, hopefully we're going to have a little bit of stability and predictability around that. Neither of them are going to go away anytime soon. Again, they create opportunities all the way around. As sad and as devastating as it is, but it's the reality of the world, reality of business. So I think looking at a macro, there's a lot of opportunities, and ultimately there's been a lot of change that's led to those opportunities. So now it's about maximizing it, capitalizing on, and making it count. This is the time to put scores on the board for the next few coming years. So thank you for that. Sorry if I've bored you to death. And again, please know that that's not investing advice, it's not trading advice, it's just purely my macro view. Sorry, I'm going to add one more thing on there. Sorry, I'm going to reverse a little bit. In terms of the capital position. So raising money in general, sorry, I should have probably mentioned it a little bit earlier in the chain. It's been particularly hard for all the companies to raise capital, and again, I've spoken this particular podcast about that earlier in the year. I think a lot of the funds, family offices, small hedge funds, have struggled to turn their cash like they normally do, but that market is that money is there, in my opinion. Most of those family offices, the funds, hedge funds, etc., they're sitting on a lot of dry powder. They just haven't wanted to deploy it or been able to deploy it. So, through the good times, they've made a hell of a lot of money. And through the bad times, they've basically pleaded poverty and not put money out as much as they could have or should have. But I believe as we now start to reach the bottom, I believe they're going to start to deploy cash again. And as I said on the stock trading, they'll probably start to deploy cash a little bit more to the better companies, which again, there's going to be fewer of. So, hopefully again, we're in a good shot with that. Now, what I mean with those funds is that they put out money at, for example, 20 cents on a stock, with a conversion price of 15 cents, for example, strong liquidity, and they were comfortable with that. The market obviously changed, stocks at 15 cents, 12 cents, 10 cents, 1 cent, in some examples. They can't get out of their positions, but equally the liquidity is not there. So even if they say, I'm happy to wash my hands, I'll just take the loss, get some capital back and redeploy, and try and, basically double down, they can't because the liquidity is not there. They're not able to sell out. But as I said, that liquidity is going to start to come back, I believe. Not fast, but it'll start to come back as people start to get more confidence and realize, actually, when I'm buying the stock, it's no longer going down every single day. It's now starting to be stable and going up, so it's a good time to buy. I think some of that liquidity will come back, which will be good for those funds. But also a lot of those funds, I said, that paper's not gone. They invested the money, they're sitting on paper. So when the liquidity comes back and the price point starts to come back over the next year or 2 or 3, that they'll be able to deploy that cash again. But also they're sitting on reserves from the good days. 2019 to 2022, most of the funds and family offices made a hell of a lot of money. So when they've got confidence that the market is stabilized, settled, and coming out, I think that will change. That money will start to come back into the market. I'm pretty sure of it. Yeah, so that's on that basis. And I think also, I'm going to sort of ramble on again, sorry for this. I think we've got an interesting time ahead, specifically relevant to us as well because of our QIND and ERT strategies. I think we've got a transition period between OTC and the big boards, or the microcap big boards. I think where it became so hard to raise money on the OTC, and everybody lost faith and lost trust in the OTC, and SEC's continual, I don't want to use victimization, it's not the right word, but SEC's ability to make it difficult for funders to actually participate in funding rounds in the OTC. Good, bad, ugly, whatever. I'm not commenting on the credibility behind that, but it became very difficult for those family offices and small funds to deploy capital in the OTC, and they became too scared. They became too scared in general, so a lot of those funds moved up to the big boards, which was the trend for the last 18, 24 months. Get uplisted, get uplisted, get uplisted. Our strategy to uplist was slightly different. Yes, it's about capital. Of course, it's about raising capital, but it's about delivering underlying value to our shareholders across our group. The QIND business is a substantial business. It'll go into hundreds of millions and into billions of revenue over the coming years. We hope, we anticipate, we expect. That business can't be on the OTC. And obviously it's not fair or not value adding to shareholders to raise money in cents when we should be raising money in the dollars, on a bigger board. But we know that business will only get appreciated by institutional investors on the bigger board, where in the OTC we will never be able to get the valuation that we should. So yes, it was about capital, but it was also about valuation. And the same applies for ERT, the ERT strategy, which we'll talk to another day on the ERT video in general. But what we've seen, coming back to this OTC thing, what we've seen is people were just driving. It was like a classic example, like we're pink sheets. We have to get, everybody drives you to get fully reporting. You get fully reporting, then you want to become uplisted. And you want to get uplisted, then what? It's kind of like it's that sort of model. Now they've got uplisted and realized their costs are 3, 4, 5, 10 times as much as they were on the OTC. They're realizing that they're under incredibly more scrutiny than they were previously. So that's not helping their stock price, because if you get uplisted and you are doing $14 million a year revenue, making a loss with some medical device that might make it or might not, you're going to get crucified. The analysts and the buyers and the short sellers and stuff in the big markets they're ruthless. They're way worse than the OTC. I'm not talking from experience because we're not there, but obviously we've done our due diligence incredibly, and we know what we're getting into. We might be jumping from a small pond into the ocean, but there's great whites in the ocean and there's only goldfish in the pond. So we are very aware of that, which is why we know we need to do it properly with substantial businesses, not Mickey Mouse hobbies. But coming back to my point, is what we've seen is these guys have moved. Everybody, these smaller companies have rushed to move up, thinking that's the greatest thing, thinking that we're going to get up to the big board. Checks are going to flow, money's going to flow, it's going to be easy because we're on the big board, we're going to be flying. But actually they list at $3, $5, whatever, get a massive pump and then end up at $1. Then they're doing a reverse split to keep above the the minimum threshold price, and they do a second reverse split. Before they know it, they've got 4 or 5 million shares trading, undesirable company, undesirable share price, undesirable, basically nobody wants to buy it. They're now on the big board, more scrutiny, more short selling, more costs, and they're still at 30 cents. And now have zero ability to raise capital because they have no liquidity. When you've got 5 million shares out, you can't get any liquidity. It's impossible, which means you're not going to raise any money. So I think, personal opinion, I think there's going to be a massive trend in 24 of a lot of companies either getting wiped out off the big boards, just basically getting kicked off. What happens, I don't know. Or a whole lot of them delisting back to the OTC, which again will bring a whole lot of new money, I would imagine. And that'll bring, I think, a lot of those investors coming back to the money pool, which is where this topic started. A lot of those investors that, family offices, small family offices, hedge funds, whatever, I'm talking about the smaller guys. Those guys felt safer. I'm going to only put my money on the big boards. SEC don't give me so much trouble. I'm going to put my money on the big boards. It's safer on a Nasdaq company or an NYSE company. Maybe a lot of them made money on that, that super hype rush as somebody uplists to $4, it goes to 8 or 12 or 16 and then crashes back, and probably they're smart enough to have sold out and got their money out. So again, they've got a lot of dry powder. But I think a lot of them now have seen actually, the grass is not greener on the other side. If I'm a small fund and I'm only deploying 100 or 200 or 500 grand at a time, on these companies that are going up and likely going to get delisted in 6 months or a year, which has become the trend. I mean, I don't know what the stats is. Maybe somebody could find these stats. Maybe it's a hobby for somebody. How many companies uplisted in 22 and 23 versus how many are now below, let's say, $1 share price? I don't know, but I would imagine it's a big percentage, a significant percentage. What I would call a real uplist of a proper company with serious revenue, serious balance sheet, serious staff, serious management team, that are going to take the company to billions. That uplisted, I'd say, are very, very few. So I think while we saw the change to big boards, I think we're going to see the change back to OTC, and things are going to almost go full circle. That's what I'm predicting kind of through into late 24. Maybe I'm wrong. As I say, it's not, it's not investing advice. It's just my personal opinion of the way I think things are lying. So I really will leave you now. I'm sorry for the long podcast. Hopefully you found some useful bits of information. And thank you very much for listening. Thank you to all our shareholders in all our different companies. And I think thank you to general traders in general for being patient with every company across this period. I think it's been tough for everybody. And you can expect and look forward to some videos from me over the next week or two on all the different companies. So again, thank you very much and all the best for the festive season. Cheers, bye.